You can count on us like 1, 2, 3, we'll be there. And we know what you need and we are count on me. We will help you with accounting. Let's learn together to achieve our dreams.
Hello everyone, welcome to Account on Me Season 2. I am Ryan L. Bactol and I will be your study partner for this video. So get ready and let's start accounting. In this video, we will discuss Chapter 7, Compound Financial Instrument. We will define financial instrument, describe a financial liability and an equity instrument, define a compound financial instrument, and identify common forms of compound financial instrument, and learn its accounting. But before natin pag-usapan ang compound financial instrument, let us recall kung ano nga ba ang financial instrument. As defined here, a financial instrument is any contract that gives rise to both a financial asset of one entity and a financial liability or equity instrument of another entity. Again, ang financial instrument ay isang kontrata na napagkasundoan ng at least two parties. One party acquires or hold a financial asset and yung isang party naman gains a financial liability or equity instrument. Now, let us focus on financial liability and equity instrument for us to better understand our main topic in this chapter. First, a financial liability is a contractual obligation to either deliver cash or other financial asset to another entity or exchange a financial instrument with another entity under conditions that are potentially unfavorable. Examples include trade accounts payable, notes payable, loans payable, and bonds payable. So here we are dealing with a liability in the form of a contractual obligation to be settled either by cash or a financial instrument. Now, an equity instrument is a contract that evidences a residual interest in the assets of an entity after deducting all of the liabilities. So generally, these are issued to shareholders of a company, and these include ordinary share capital, preference share capital, and warrants or option, which we are already familiar of. Now that we've discussed what is a financial instrument, financial liability, and equity instrument, let's now discuss our main topic, compound financial instrument. With the name itself, compound, it is a financial instrument that contains both a liability and an equity instrument from the perspective of the issuer. Basically, compound financial instrument has two components that meets the definition of a financial liability and another, an equity element. Examples include bonds payable, issued with share warrants, and convertible bonds payable, which we will tackle more later on. Pero ba't nga ba may ganitong compound financial instrument? Basically, these are offered by an entity for the sake na mas maengganyo or maging interested ang isang investor to invest money to a company. Moving on to the exciting part, let's learn how do we account for compound financial instruments. First of all, the issuer of a financial instrument must assess whether it contains both a liability and an equity component. If it does contain both of these, it should be accounted for separately. So in accounting for compound financial instrument, kailangan nating paghiwalayin yung dalawang components. And this is what we call split accounting. We allocate the consideration received between the liability and equity component. So how do we allocate? Generally, the fair value of the liability component is determined first and we'll deduct it from the total consideration received. And yung natitira or residual amount, ito na yung i-allocate sa equity component. As mentioned earlier, there are two common examples of compound financial instrument: bonds payable issued with share warrants and convertible bonds payable. Let us first discuss bonds payable issued with share warrants. Obviously, here the issuer, aside from bond, may kasama ring share warrant na inattach. In effect, the bondholders are given the right to acquire shares of the issuing entity at a specified price at some future time. However, attached share warrants may be detachable or can be traded separately or non-detachable or hindi pwede ihiwalay doon sa bond. Either way, detachable or not, share warrants shall be accounted separately. Now, how do we allocate the issue price? Applying what we have discussed earlier, the bonds or the liability element are assigned an amount equal to the market value of bonds x warrants. Basically, we will determine the market value or fair value of the bonds excluding the share warrants, saka natin i-deduct sa issue price. Then, the residual amount shall then be allocated to the share warrants. Here is an illustration to help you understand bonds issued with share warrants. Stated here, an entity issued 5,000 10 years bonds payable face amount 1,000 pesos per bond at 105, and each bond is accompanied by one warrant that permits the bondholder to purchase 20 equity shares par 50 peso at 55 per share or a total of 100,000 shares, while the market value of the bond without warrant is 98. Now, let's compute the allocation of the issuance of bonds payable. In this illustration, as we've discussed earlier, we have to deduct the market value of the bonds to the consideration received and then allocate the residual amount to the share warrants. So, issue price of bonds with warrants, 5,250,000, which is computed by multiplying the 5,000 bonds to the face amount of 1,000 pesos per bonds times 105%, minus market value of bonds without warrants, 4,900,000, which is computed by multiplying 98% the market value of the bond x warrant to 5 million. The difference is the residual amount allocated to share warrants amounting to 350,000. Now, to compute the discount on bonds payable, we can simply get a difference of face amount of bonds payable and market value of bonds x warrant, and we will get 100,000. Moving on to the journal entry, we can now debit cash 5,250,000, discount on bonds payable 100,000, and credit bonds payable 5 million, and share warrants outstanding 350,000. Now, what if the bondholder exercised 60% of the warrants? Using the information provided in the illustration, we can get the issue price of shares by multiplying 60,000 shares, which is 60% of the 100,000 share warrants, to 55, the exercise price, resulting to 3,300,000. Then, to get the share warrants exercised, we'll simply get the 60% of the 350,000 share warrants outstanding that we have credited in the first entry, resulting to 200,000. Then we'll add these values together and deduct the par value of shares 3 million computed by multiplying 60,000 shares to 50 par value. The result would be an excess of 500,000 to share premium. The journal entry would be a debit to cash 3,300,000, share warrants outstanding 210,000 since these have been already exercised, and a credit to share capital 3 million, and the share premium 510,000. If the remaining share warrants are not exercised and subsequently expired, the journal entry is to simply debit out the remaining share warrant outstanding, which is for 140,000, and credit share premium and exercised warrants 140,000 also. Now, let's tackle what to do when the market value of bonds x warrant is unknown. In this illustration, an entity issued 5 million peso face amount 5-year bonds payable at 120. Each 1,000 peso bond was issued with 20 non-detachable share warrants that entitle the holder to purchase one share of 20 peso par value for 25 peso. Interest rate is 10% annually every December 21. A prevailing market rate of interest for similar bonds without warrants is 12%. Now, in addition, the present value of 1 at 12% for 5 periods is 0.57, and the PV of an ordinary annuity of 1 at 12% for 5 periods is 3.60. Here, the share warrants are non-detachable. Nevertheless, we have to account it separately. Since the fair value of the bonds ex warrant is unknown, we have to use the present value of the bonds payable. To come up with the answer, we have to compute first the present value of the principal by multiplying the face amount of bonds, which is 5,000,000, to 0.57 present value as provided in the illustration. As a result, we'll get 2,850,000. Then, we'll also get the present value of interest payments. Since the interest rate is 10% annually, we'll have to multiply it to the 5 million face amount of bonds and multiply the result to 3.60, the present value of the ordinary annuity as provided in the illustration. The result is 1,800,000. Now we simply add these values together to get the total present value of bonds payable. Subsequently, we can now deduct this to the issue price of 6 million or 5 million face amount times 120%. The result of 1,350,000 is the amount that will be allocated to the share warrants. So, in similar way of journalizing, we'll come up with this journal entry. Debit cash 6 million and credit bonds payable 5 million. Share warrants outstanding 1,350,000. The remaining balance is debited to discount on bonds payable 350,000, or we can also compute this by deducting the present value of bonds payable for 1,650,000 to the face amount of bonds 5 million. If the entity exercise all the 100,000 share warrants, the journal entry is a debit to cash 2,500,000 computed by multiplying 100,000 shares to 25 exercise price. Since all warrants are exercised, we will also debit share warrants outstanding 1,350,000 and credit share capital 2 million computed by multiplying 100,000 shares to 20 par value and a share premium of 1,850,000, which is the excess. Now that we've covered bonds payable issued with share warrants, let us move on to the next compound financial instrument, which is convertible bonds. Convertible bonds are bonds which gives the holders the right to convert their bond holding into share capital or other securities of the issuing entity within a specified period of time. This being said, we can conclude that it has the component of both a liability and equity element, making the bonds convertible, making it more attractive to investors, as I have said also a while ago. Oftentimes, conversion privilege becomes less attractive as time goes by. For example, 15-year 1,000 peso bond may be convertible into 20 equity shares during first 5 years from date of issuance. Then equity shares the next 5 years and may not be convertible during the last 5 years. Now, if convertible bonds are issued at a premium or discount, as discussed in Chapter 5, amortization period is only up to the maturity date instead of the conversion date. Why? Because it is difficult to predict if whether all the conversion privilege will be exercised. There are two situations that we will delve into later on, when the convertible bonds are originally issued and the convertible bonds are converted. Let's tackle convertible bonds payable during original issuance. As I have stated a while back, convertible bonds are conceived as compound financial instruments, which is why it should be accounted for as partly liability and partly equity. Just like what we've been doing, with a little modification, the issue price of bonds should be allocated between the bonds payable and the conversion privilege. How do we allocate exactly the issue price? Again, it is substantially same as issuing simultaneously bonds payable with share warrants. Bonds payable are allocated an amount equal to the market value of the bonds without the conversion privilege, and the residual amount of the issue price is allocated to the conversion privilege. In the instance that the market value of bonds payable without the conversion privilege is unknown, it will be equal to the present value of future interest payments using the effective or market interest rate for similar bonds payable without conversion privilege. Again, here is an illustration. An entity issued 5,000 5-year bonds payable face amount 1,000 peso each at 110. Bonds contain a conversion privilege that provides for an exchange of 1,000 bond for 20 equity shares with par value of 50 pesos. It is also reliably determined that the bonds would sell only at 95 without the conversion privilege. Let us first compute the issue price of bonds payable. Since there are 5,000 bonds with face amount of 1,000 pesos, we have a total of 5 million bonds at face amount. This will then be multiplied to 110%, resulting to 5,500,000. Stated in the illustration that the bonds would sell only at 95 without conversion privilege. This is the market value. Again, we will multiply this to the 5 million bonds to get the issue price without the conversion privilege, resulting to 4,750,000. Now, all we have to do is get the difference between the two values, and we will get 750,000 residual amount to be allocated to conversion privilege. To compute the discount on bonds payable, we only need to deduct the allocated issue price to the bonds payable at face amount, resulting to 250,000. Here is the journal entry. A debit to cash 5,500,000, discount on bonds payable 250,000. Credit on bonds payable 5 million, and share premium conversion privilege 750,000. Now, what do we do if the market value of the convertible bonds is unknown? In this illustration, an entity issued 5,000 5-year bonds payable, face amount 1,000 peso each, bond at 120. The bonds contain a conversion privilege that provides for an exchange of 1,000 pesos bond for 20 equity shares with par value of 25 pesos. Stated interest is payable semi-annually at a nominal rate of 8% per annum. And when the bonds are issued, the prevailing market rate of interest for similar bonds payable without conversion privilege is 10% per annum. Since the interest is payable semi-annually, the 5-year bonds payable will have 10 interest periods, and the market interest rate will be 5% or 1/2 of 10%. Moreover, the present value of 1 at 5% for 10 periods is 0.61, and the present value of ordinary annuity of 1 at 5% for 10 periods is 7.72. Let's proceed to the computation. First, we'll get the present value of principal by multiplying the 5,000 bonds to the face amount of 1,000 pesos and multiply it again by the present value of 0.61. This will result to 3,050,000. Next, we'll get the present value of the semi-annual interest payments by multiplying bonds at face amount 5 billion to the present value of 7.72 as stated in the illustration, which will result to 1,544,000. Summing up, we have a total present value of bonds payable 4,594,000. Now, all we have to do now is to deduct this to the issue price of bonds with conversion privilege, or simply computed by multiplying 5 million bonds at face amount to 120%, which is 6 million. The residual 1,406,000 is the amount that will be allocated to the conversion privilege. With the computed value, we can now easily journalize. Debit cash 6 million, discount on bonds payable 406,000, credit bonds payable 5 million, and share premium conversion privilege 1,406,000. Moving on, let's discuss accounting for convertible bonds on conversion. Here, the main problem when the bonds are converted into share capital is the determination of the value to be assigned to the share capital issued. As stated here, the carrying amount of the bonds will be the measure of the share capital issued, because basically it is the effective price as a result of conversion. And since convertible bonds is viewed in substance as an equity, and the conversion is an exchange of one type of equity capital for another, there is no gain or loss on conversion of maturity. And costs incurred with the bond conversion shall be deducted from share premium arising from the bond conversion. In computing the carrying amount of the bonds payable, it will be equal to the face amount plus accrued interest if not paid, plus an amortized premium on bonds payable, or minus an amortized discount on bonds payable and bond issue cost. In accounting for the conversion of convertible bonds, the amortization of discount and issue cost or premium up to the date of the conversion shall be recorded. The face amount of the bonds payable converted shall be cancelled together with the related unamortized premium or discount on bonds payable and issue cost. And if only a portion of bonds is converted, then the unamortized premium or discount on bonds payable and issue cost balance shall be cancelled proportionately. Most of the time, conversion is at an interest date, when at other dates, the accrued interest up to the date of conversion is ordinarily paid. When the interest is not paid, it is added to the face amount of the bonds payable converted to get the carrying amount of the bonds payable for conversion purposes. The accrued interest is charged to interest expense. Let's try to discuss some illustration to better understand conversion. The statement of financial position showed the following balances at year end as presented here. On the same date, the bonds are converted into share capital. The conversion ratio is 20 shares for each 1,000 peso bond, or a total of 100,000 shares. The cost incurred in the conversion amounted to 100,000 pesos. In addition, the accrued interest on the bonds payable on the date of conversion is 150,000, which is paid in cash. Let's proceed to the computation. First, we need to get the total consideration by summing up the bonds payable 5 million, premium on bonds payable 200,000, and share premium conversion privilege 500,000, resulting to 5,700,000. Afterwards, we'll deduct the par value of shares issued, which is 4 million, or 100,000 times 40 par value. We'll debit the converted bonds payable 5 million and its related premiums. Premium on bonds payable 200,000, share premium conversion privilege 500,000. We will also debit the accrued interest expense of 150,000. Then, a credit to share capital 4 million, share premium issuance 1,700,000, and cash 150,000. To journalize the cost incurred during the conversion, we only need to deduct it to the share premium related to the conversion. So we will debit share premium issuance 100,000 and credit cash 100,000. Now, let's discuss how to account payment of convertible bonds at maturity. On December 31, 2021, the statement of financial position showed the following balances. The bonds are convertible and originally issued on January 1, 2012. Stated rate interest is 10% payable annually every December 31. The original issue price is 6 million. In this illustration, the convertible bonds are not converted but fully paid on December 31, 2021. Here, we can derive that the issue price of bonds without conversion privilege is 5,600,000 to get the share premium conversion of 400,000. The issue price without the privilege deducted by the price amount will result to 600,000 premium on bonds payable. Since the bonds already matured, the premium on bonds payable is already fully amortized. Here are the journal entries. Debit bonds payable 5 million and interest expense or 10% of 5,500,000 and credit cash 5,500,000. To record payment of bonds on December 31, 2021. To close the share premium from conversion option, we simply debit share premium conversion option 400,000 and credit share premium issuance 400,000 as well. What if the payment of convertible bonds is before maturity? In this illustration, on December 31, 2021, the statement of financial position showed the following balances. The interest is payable annually every December 31. The convertible bonds are not converted but fully paid on December 31, 2021 for 5,400,000 plus accrued interest. And on December 31, 2021, quoted price of bonds payable without conversion privilege is 103. First, let's compute the equity component of the convertible bonds. First, we'll deduct the fair value of bonds without conversion privilege, 5,150,000 or 5 million times 103% to the payment of bonds payable 5,400,000 which will result to 250,000. Next, we'll get the carrying amount of bonds payable by summing up the bonds payable, 5 million, premium on bonds payable 300,000 resulting to 5,300,000. Subsequently, we will deduct it to the payment applicable to the fair value of bonds without conversion privilege, 5,150,000, resulting in a gain of 150,000. To journalize the payment before maturity, we will debit bonds payable 5 million, premium on bonds payable 300,000, share premium conversion privilege 250,000 that we have computed earlier, and credit cash 5,400,000 and gain on extinguishment 150,000. To close the remaining balance of the share premium from conversion privilege, we simply debit share premium conversion option 350,000 and credit share premium issuance 350,000, which is the difference of 650,000 and 250,000. And that's it for compound financial instrument. I hope you've learned a lot. Thank you so much for watching and listening. See you on our next video.